Cisco wrote off $28 billion of revenue because they were giving startups capital equipment to grow into the internet. OpenAI is buying somebody's chips and they're committing to it. And so you get this circular thing going on where the capital just doesn't have a return. Smaller always has the opportunity to have, bigger multiple outcomes. We've tried to keep the discipline of staying in that 250 range. This velocity between and ping-ponging between capabilities is so astonishingly fast. Is how do you innovate and keep up with that is going to be a real interesting question.
Austin will go through kind of a rebirth.
Most advanced technology in the world, and if you can't actually build it or ship it, then what's the point?
You need storytellers who are able to paint the picture of what's happening at the frontiers of technology.
The U.S. needs to get back more to that and less like lawyerish and more we're building stuff.
The frontier isn't just a place, it's forged in the fire. Welcome to Austin Next.
Ryan, welcome back to Austin Next.
Well, thank you, Jason. Good to be with you.
I think a few things have changed since you were on in 2021. I was looking at it's like episode 20 something. It's like 140 episodes ago.
Well, congrats. That's awesome to hear.
Yeah, a lot has evolved on the podcast. A lot has evolved in Austin. And then I want to start off with kind of a big news you just announced involving S3. You guys got Fund 8.
Yes, we're proud to announce Fund 8, another $250 million fund, and excited to put it to work in software and healthcare.
So is it the same? Is your thesis evolving? How are we thinking about Fund 8 versus the previous 7?
Yeah, so it's probably good to reflect quickly on Fund 7 because we did about half of our deals outside of the state of Texas. And so we'll talk about that a little bit today. We're going to continue down that path. And so it's going to be AI, it'll be enterprise software, it'll be healthcare and med tech are going to be the focuses. So same focus, same kind of seed through Series B as our first check, and kind of check sizes, 500,000 to 15 million as our entry point, and then we'll go a lot deeper than that over time.
That's a bit of a range in terms of your of the starting point. Well, let's start with that then. You talk about like AI software, healthcare. Okay, AI means a lot of different things. I'm guessing, especially that would joke on like that's a wide range, but you're not then able to jump into like the thinking machines, $10 billion or $2 billion seed.
Right.
What do you mean? Where in the stack are you thinking about when you say AI? And then how do you see about like the rush that's going on into like, the foundational models and these gigantic capital expenditures?
Yeah, no, it's amazing. The capital, big CapEx is not for us. That we're really looking, in a sense, kind of like our SaaS heritage with enterprise software. We're looking for application uses of AI that really transform the enterprise, that help them do what they do better. And so, yeah, it's going to be more the model of efficient use of capital versus these ginormous, fundraisers. That's not really for us.
And so we talk about the SaaS heritage. I mean, I think we're still trying to figure out this business model, right, of AI, because, you hear a lot about, talking about the foundation models, it's all subscription based right now or API based. But then there's the rumors of advertising, which just I don't want. And I'm hoping that is just rumor and stays a rumor. But then, when you have something that's more an outcome based, are you starting to see a shift in business model, or a lot of these kind of companies that are still in the application layer trying to apply that business model to the AI world applications?
Well, I think applications are key. And I think the area that AI has innovated is use of data, right? To make assessments, to make judgments, to provide insights. And so the area that we're focused on has a lot to do with knowing the source of truth. In other words, the data that's in your enterprise. How do you use it to help you as the business make better decisions? So in a sense, it's taking that next step up in the stack, because you were writing applications without kind of knowing the data. Now you know the data and you want to use that to make even better decisions. So that's the idea what we're trying to invest in.
Do you see competition between the application layer and essentially the in-house X vibe coding engineer where, okay, I just need this done and it's created using our data, as you said, and we can just hire these people with these new developer tool sets to just build it quickly in a way that wasn't possible versus, okay, here's a, vertical AI, perfect thing for my business.
Yeah, the analogy I'll use is think about UI UX. There's some really great tools to help you visualize the way to interact with an application, but a lot of times you'll use a very rapid prototyping tool to get what you want. Then you're going to go back and code the more consequential, error-proof kind of functionality. So I see that kind of happening here where, yeah, the vibe coding can get you an idea of what you want it to look like, but then you're going to go back and do the real work of the software development to make it enterprise ready.
These enterprises have look. I can't code and I can code now, right? My 12-year-old is vibe coding and creating things like an amazing level. So like I see where he's headed, and a lot of these great engineers are. To your point, I think vibe coding is going to, obviously the term probably go away because it's just going to be part of the stack. Like I get the first phase, he gets me 60% there, then I go in and do the harder work. But with the speed, I'm hearing a lot of kind of headcount neutral companies, and they're doing, but we're all in an AI. We're kind of, it's giving these engineers and these different product people superpowers. So how does that compete? How does the application AI companies compete against almost the build part of rather than buy in the buy build partnership?
Yeah, again, I think you're giving new tools to the enterprise, and so they just have to make decisions on their resources. What do you want to spend your engineering dollars on? Do you want to spend it on developing these enterprise apps after you kind of prototype something? And so to me, it's really an allocation of resource kind of question of where do you want to spend it? Sure, there's great ways to go develop new uses and new interfaces, but ultimately you're going to have to do the hard work of making it enterprise ready. And I think that's really where a lot of the resources is going to get applied. So again, it's kind of, to me, it's kind of like product management might have that vibe coding feel, but dev is going to have that really hardened enterprise work.
Is it a definitional term difference between like the applications versus the agents? Or are you seeing a real difference in terms of the types of companies that you're going to be investing in that are application versus agent layer?
Yeah, and there's definitely some distinction there, and I think we could talk about that for a long time. But the agents are you're basically saying, hey, I already know some decisions I want you to make based on the data. Go ahead and make them. So you're giving autonomy to the assessment of the data, and that's where I think that the agentic thing is going to be super exciting to complement the applications as well. So they'll live together.
Do you see the companies viewing both kind of their application products and their agent products that are, or do you see them kind of right now, especially at the early stage, or maybe it's a question as you're seeing the kind of development? Are you seeing them focusing more one on the other, or is it more? We were talking about applications, a year and a half ago. The ChatGPT is only 2.5 years old, so it's all moving fast. Versus like agents are the new thing, so everyone who's coming and pitching you guys is talking agents.
Well, again, agents are a new thing, and we're certainly hearing early stages of that. I don't know that I would say, yeah, I probably would say, still dominantly application oriented is where it is today. And that will augment over time. It's just hard to know exactly what that split is going to look like.
When you're kind of assessing the kind of the companies coming in, especially in the last 18 months and going forward, how are you thinking about the stack and the way that they are built as a company? Whether they're coming in as an AI company or not, are you assessing their usage of these new tools to actually increase speed, just be better as a company?
Yeah, I think that, as you would imagine, a new company today is kind of AI native. And so they're already aware of many of the tools and the features that are available. And so our assessment would be, tell us how you're using the product. The old saying, you eat your own dog food, right? So do you kind of use the tools that you're trying to get others to use? And so, yeah, we want to see that for sure. Yeah, so that's probably where we land. We'd want to know that they're using them, give us a sense of what they're learning from them. And then the existing companies that are, leveraging new AI features, they're kind of taking steps in that direction. And so they're not native yet. So you got this distinction of you've been around a while, now you're applying it, or you started native, and how are you using those tools? So there's definitely a distinction there.
Moving to the enterprise software, we talk about something like AI applications, but is the enterprise software only AI applications at this point, or are we seeing, is there a market of different things? Are there still SaaS companies, or are they all just evolving quickly? How are you seeing that part of the market?
Well, there are definitely some good SaaS companies and long live SaaS, right? I think there's still some things that AI, LLM kind of things just are not going to be able to do in that world. And that's fine. And we'll still see that development. But increasingly,
is that due to the specificity and the hallucinations, or is it something else that there's an area that you don't think they're able to touch?
Well, in some cases, in regulated spaces, I think about governance and fintech and compliance, where you just cannot have any variability. You cannot have a penny off in a financial transaction. And so there are areas where I think it's just really critical to not have any variance at all, because if you do, you're kind of done in that space. And so there are definitely areas where you just can't leverage any of that risk, but you can still, get benefit from it. We just got to make sure that the decision making is based on facts.
And are you seeing that from, it's just kind of traditional, that's kind of leveraging your own data? Is it these kind of traditional SaaS? Is it kind of, cloud-based? Is it kind of, this is me, the non-software engineer, trying to understand the structure? Are we seeing changes that are happening in that field as well? Or is it just very much what it's been and kind of incremental improvements in the sector side? So it's fintech changing.
Whether it's on-prem or cloud doesn't really affect the implementation. It's what is the source of truth, and is there any variance at all that can happen? And just got to keep any variance out. So fintech's a great example where you just can't have any variance at all there. And so you got to know the source of truth. Now, when you're making decisions in an enterprise and using your own data to make kind of decisions that are directional, certainly wonderful use. And the tool is just really, the tools are amazing.
I want to pivot to the comment that you made about that Fund 7, over half of the companies came from outside of Texas. When we first met, when I talked, go to the website, it was like, we are Texas focused. So kind of walk me through that evolution. Is it been the competitive nature of what's happening in Texas, and so you're going to look for alpha? Is there a poll that you're like, hey, we know we see this in other places and we can get ahead of it? Is it just, hey, great deals are coming? I mean, how are you seeing that evolution and kind of what drove it?
Well, it's first important to say, we were born 20 years ago here in Texas. And so
nothing's changed since that time, right?
A lot has changed, as you know. And I think firms evolve over time, Jason, as they have success and build their networks. And that's been true for us, that we have increasingly been able to see and be involved in deals that are broader than just geographically in Texas. And our networks have taken us there. Our successes in prior deals, they've gotten us introduced to entrepreneurs that are in new spaces. And so we've just followed that. And now I think we're in 13 states at this point with our investments. And we're going to continue to follow our networks into those places. So born in Texas, spending a lot of time looking nationally at where our networks take us.
And is that non-traditional, mid-tiered? I don't mean that negatively. Or is it, no, you're going also to, SF, New York, Boston, competing again in those hubs?
Yeah, I would say that in the spaces that have very mature venture markets, we will go in when there are introductions, but probably not go in proactively. And so, as you know, healthcare, lots of stuff going on in Northern California. And so we're seeing more there as an example, and some other spots that are in the US, like Minneapolis and Boston. And so I think we'll follow the network, but we're not going to, in some of those very mature places, we won't pursue it kind of directly.
And what about the more immature? I think too much. But like when you think about like North Carolina, you think about Colorado, you think about some of these places. Are you seeing? Is it very opportunistic? Are you seeing those markets starting to evolve to a point that there's going to start being more? We said in 13 states, more of an engine, or is it just, hey, our network's pulled in and we're going to see this, this, that, or the other?
Yeah, I mean, there certainly are some repeat places, Jason, we've seen success in the Research Triangle area for sure, and software. Denver is similarly in that area, and so we're seeing and having opportunity with multiple new deals in those areas. So I see, just like Austin emerged and has grown, over the last 30 years, these other places are growing too, and tech is kind of borderless, and so I think it'll these will be good places to grow.
Are you seeing in any, let's just say, like you mentioned, like, Research Triangle in Denver, are there particular regional first principles that kind of line up? They're like, okay, so what we're seeing out of Denver, it's not the same SaaS as we're seeing over here. It fits the Denver market in this way. It almost feels like a Denver company, Research Triangle. I mean, when I think about Austin, there's starting to be a flavor of, an Austin company, which is different than an SF company, which is different than a New York company.
Yeah, it would be hard to pin it down vertically. In other words, it'd be hard to say that Denver is specifically this kind of application area.
Right.
And so I don't think it's that much, but cities do develop that. Like if you look back at the history of Austin, there was a lot of fabless semiconductor here early, and there was a lot of application software here early. So I do think there can be those things. I'm not close enough in some of those to give you specifics, but they should, over time, as they have successes, there should be, like security or fintech or whatever. Those things should emerge in those cities.
Last time you were on was 2021, and
Yeah.
the venture bubble was doing some interesting things, and a lot of people who both raised funds and capital and startups during that time period are hurting a bit right
Yeah.
now. That is getting kind of flushed out. At the same time now, like it looks like 2025 is going to be a record. I know definitely for Austin, a record year. I think a record year kind of across the board. So we're seeing some of that rush again. What is your kind of sense on the rhyme? Are we seeing the same kind of thing that we saw in 21 that we're all going to get hit with in a couple of years, or this kind of feels a little bit different? Or is there a different era, since you said it's not 20 years ago, that might be a better, parallel?
There's a little bit of macro influence, I think, that's important. Number one, there was so much money coming into the markets in 20 and 21 with low and almost zero effective interest rates. And so the need to return and look at free cash flow in terms of valuation was like time was infinite. And so growth was king. And so you were basically paying up for growth, and that was the only thing that mattered, because there's so much money was available and super low interest rates. So that's a very different dynamic than what we have today. In fact, we took advantage of that, frankly, on the selling side to exit a couple of deals in 21. But now what you have is this groundswell change. I mean, interest rates are obviously up a little bit. Cash flows do matter in the long run, but the groundswell is a whole new application product tool set, if you will, that AI brings, that is kind of like the internet in the .com era. It's just so profoundly big that it has its own kind of momentum to it. So different than 21, but this is a real thing, probably with some better financial underpinning, because the money's not completely free. But then there's also the overdoing it
I
of
was going to say, is that
so much capital.
yeah, the internet, boom ended in the 2000, 2001 bust.
Right.
But obviously, from a same thing, oversupply that ended up benefiting everybody. People talk about. Do you see this kind of same with like the data center book and everything happening? Are we rhyming again?
I think you're spot on. And so the analogy I think about is, you may remember this, but in 2001, I think Cisco wrote off $28 billion of revenue because they were giving startups capital equipment to grow into the internet thing. And so they basically, one analyst said that the Bellagio hotel cost $1 billion to build, and Cisco wrote off 28 Bellagios. And so, but see, you see the same thing happening today, where OpenAI is buying somebody's chips and they're committing to it. And so you get this circular thing going on where the capital just doesn't have a return model. And so I'm kind of like, it could get bumpy here in the next few years.
What about the exit market though? Are we starting to see? I mean, we're having a couple of we're recording this at the very, very end of the 25. I mean, we saw I think Manus, or not perhaps, like bought by Meta, like $2 billion. I don't know why people are throwing in like the last day of the year now. So I don't know if this is the best time to now, but like, so we're seeing some interesting acquisition. We're also seeing some very, I don't quite understand like the nature of these license,
Mm.
you know, Aqua-hire 20 billion, like, NVIDIA Rock, that on that dynamic, I think that the VCs and some people are getting paid, or some other, we saw like, Windsurf's, your case we're also seeing the IPO market. I was reading somewhere, actually was interesting, is that feels like the IPO market has definitely opened. We're feeling a lot of kind of deals. If you look at the actual volume number, it's nowhere near where we need to be, but it's definitely, but like your bar is like 22, 23, but like we had like nothing. So like,
Yes.
it's kind of where your reference point is. So how are you seeing, the exit market? And then also almost your term of patient capital. How do you guys think about secondaries as well?
Yeah. So lots of questions there. Number
Yeah.
one, the IPO market is definitely returning, and that's a good thing. That's healthy for exits, because when you are healthy for the ecosystem, when you have exits, you can, redeploy capital and have kind of classic returns based on that. So I think broadly speaking, good to see the IPO market coming back. They are bigger issues, and companies are obviously, as you know, going later in the life cycle. So that's one thing.
Or you mean
to talk about.
SpaceX's announcement of a $1.5 trillion IP? Like I don't even understand how to comprehend that.
Yes, it really stretches. You think about back to 2012 when Facebook went public at 100 billion, and that just, is 1/15 of this one, right? So it's just a kind of a staggering rise. It does mean that money is staying in private, longer, which is kind of pointed toward us in terms of patient capital, because we're able to stay with things much longer and, build them and grow them. And I think that's going to be where the returns are captured, as opposed to, like, think about when Microsoft and Oracle went public, the majority of their return was in the public market, whereas now the majority of the returns in the private market. And so that's good for private investors as they recycle capital in those bigger dollar things. They've got to live longer, of course, and that may change structurally how venture gets done. But it does take away the broader opportunity for the American public to participate in those things.
Yeah, no, it's when you have that, the 1.5 trillion, you said, so I assume, and I think, just given where we are in the space race, there's still more upside. OpenAI, like at this rate, it'd be $1 trillion when it like, that's a lot of, to your point, that the general public isn't getting access to.
Yeah, and it's hard too. I look at OpenAI and some recent articles about when their profitability is going to come. I mean, you have to suspend disbelief for a long time before they generate cash flow, which is like 2032. And so, do those kind of investments make sense? Yeah, I mean, in other words, back in 21, when companies were going public, you could be growing a lot and still be EBITDA negative, but that doesn't exist today. And so, can a company like that get public and be valued? Well, it looks like it can be in the short term, but will it, last in the long term?
Right, and we'll see more scrutiny on some of the, what's good revenue versus not good revenue.
Yeah.
But I feel like the push is coming from these unbelievable growth rates, right? You got any companies hitting $1 billion in like a year, or, this was, when Oliver X and everything was Brian Kim from A16Z. It's like $2 million in AR in 3 months used to be impressive. Now we expect it within 10 days. I don't even know how feasibly, from the demand side, where's even all this money coming from? They're getting, I mean, look, I spend personally too much on AI. I have like subscriptions to like all of them. And that's at the one tier. And then like, I'm always worried when like they're all going to get turned up to the $200 tier. It's like, I can't do that.
Right. Well, if you have the rotation, I mean, money has to come from somewhere, right? So if there's a rotation out of, like, let's say SaaS companies into these AI first companies, because a portfolio manager believes that he or she can make their number in 2025 by getting into some of these big things, right? So they're rotating, the cash is coming out of other public things or other private things and then flowing into these kind of unicorn, decacorn, whatever the 100 corn is.
Need new words again.
Yeah, we need new words, but you just see the cash rotation is where it's coming from. But ultimately things have to make money and they have to have discounted cash flow and they have to make sense from an economic return. And even if the numbers flow from the billions into the trillions, it still has to make economic sense someday. And those days of reckoning, I think, are coming.
Do you see it being a reckoning along the lines of like the Cisco write-off? Do you see it being, down? Like what do you think is driving, or do you see it being like, more demand driven? We're like, okay, there's 10 companies, and then you know what? Somebody crossed over that it went to 3, and those 7 are screwed.
Well, I think there are 2 principles here. One principle is typically market leaders and number 2 get the lion's share of the capitalization. So that's always a good thing to remember. And then you can look at these kind of overhyped run-up kind of bubble things, and they often mean that stock prices are stagnant for even decades. And so I think, in fact, if you look, Bank of America, as an example, just surpassed their high from like 2007 or 8. And so you're talking about 17 years of a real stagnant market cap and share price. So these things, life is trade-offs, and any kind of run into something is going to have a bleed out on the other side.
Yeah, I don't know the exact numbers, but it's something like, whatever the S&P 500 is up in the last, give it X, but it's, I don't know, 60, 70, some huge percentage is like, the Mag 7,
Yes.
which then implies that everything else is either flat or down.
Right. And that was my comment earlier about rotation out of certain areas. If I'm the portfolio manager, I want to get out of something that's a good business because I can make my number right now, and these other things that are growing in crazy amounts. I mean, what, Google's up 60% this year or something like this. That's astonishing.
I'll give them credit. And I was very much like ChatGPT was like my singular. And then when Gemini 3 dropped, I've actually rotated and been, I'd say 50, 60% on that now. So, and it's the benefit of I'll call it, the tiers of, at least from the consumer side, maybe the enterprise different, pricing is like, okay, fine. So if I have $20 or $50 on each, the stickiness and the lock-ins are more, it's memory, right? Like that, the biggest thing that's kept me locked in ChatGPT is that memory function's amazing. What will be interesting to see is, I know memory on Grok is rolling out, Gemini is starting to roll it out, which is obviously these are strong positives and that can only get better. They always joke, this is the worst it's ever going to be.
Yeah.
The significant benefit, of course, is going to be when you can move memory around. That, of course, the value to those companies is like, no, we don't want that permissibility kind of across, because then it's going to be purely feature based and everything's going to be kind of jumping around.
Yep. Well, you're really bringing up a great point here, which is innovation velocity is so high today. I don't think we fully understand the implication of that in the financial markets, because that's ultimately what's going to finance future things. But this velocity and ping-ponging between capabilities is so astonishingly fast. Is how do you innovate and keep up with that is going to be a real interesting question.
Do you see that capital rotation on the private as like, okay, so everybody's running to this set. Now, maybe on one side, that is a set that you invest in, or another is saying like, okay, it's demand driven, driving supply constraints. So this is an area that we can step in differently than others can.
In terms of kind of our specific investing thesis, or
do you see it as an opportunity, or do you see like, okay, because that over rotation, that they're gonna see purely stagnant in this set, and so like we're over rotating out as well.
Yeah, I think 2 things. Discipline always matters, and ultimately good businesses are what we want to invest in. Kind of that would be my first point. Number 2, because of the patient capital, Jason, we can be in things for lots of years, not just in cycles. And in fact, most of our funds have invested across economic cycles. And so to try to plan for that would be very difficult, I think. And so we're trying to find great entrepreneurs who are going to change the future and, put the right amount of capital to work, make sure that the product market fit is there. The things that you talk about a lot in disciplined investing, we want to make sure those things are there and then just invest through the cycles.
How do you think about your patient capital early stage, right? Or however we define early, kind of see that 5 to 15 that's going on. How do you think about the partnerships with like the later stage VCs and aligning that kind of patient capital, making sure that, you know, you guys are getting with people, or do you see it, is it kind of it's almost a separate class of kind of groups that you tend to work with, or is it, you know, everybody and anybody as you kind of think about it?
We've invested with a lot of different firms over the years, and we happy to work with some of the bigger capacity investors for later stages. And yet sometimes we've kind of carried the water ourselves in certain deals, but primarily we'd like to syndicate with folks who have Series C, Series D kind of capital. And I think about like Alchemy, where we had General Atlantic join us in the Series D. So those are things where we would welcome those bigger checks for businesses that are working, and happy to partner with them.
It's funny, you just said Series D here, and I'm like, I understand that it's patient capital, but is there a point? I think was Databricks like Series K or like it's getting a little ridiculous on some of the funds. Like, uh, how do you think about being patient and good businesses versus there is some, we don't want to lose velocity, we don't want to lose like being impatient. There's a value to it as well.
One of the things that we talk about a lot, Jason, is kind of knowing your moment. And so there are times when, like in an M&A transaction, a buyer shows up, they're interested in the company, and you may be on Series E, but it just makes sense to exit at that point. So I think that'd be one principle that I would apply, is we need to know our moment, and exits are good things as long as the founders are excited about it. And that's often what we find in our deals, is they're kind of leading the charge in that. We're happy to continue to go and build the business further, but this is a kind of a good point to exit. So I'd say that's kind of one element, is knowing your moment. The second thing is we really get paid on multiple of invested capital. And so as long as the business is building value and growing that MOIC over time, we'd like to take advantage of that.
Got it. Well, that makes sense. I want to drill down now to like Austin itself, and even like, so, you know, literally actually just celebrated my 5-year anniversary of moving here. And it's funny because we say, like, I feel like it's been 3 mini cycles within. You had like the 21, 22 stuff, and they pulled back, which I always kind of joke about in 23, 24, because it was higher than every other year prior to that. So it's a bit of a pull. And then we seem to be entering another year here. Is we got $8 billion invested in startups, which is almost $2 billion more than our highest record from the bubble. And I do feel like some of these companies are more built to last and creating some kind of generational things. But at the same time, kind of, I think a lot of that 8 billion is being driven by massive, you know, rounds. We had like, you know, Base had $1 billion, Electronic had 500, Ninja wanted 600, Saronic at 500. I think I'm off a little bit on some of these numbers, but like deal sizes that I don't think Austin's really ever seen before.
Mm-hmm. Yeah.
What would you say is kind of the state of the Austin market?
I've been here 35 years, happily growing. And so, you know, glad you're here for these 5. It's continuing, Jason, to grow and flourish. And the things you're seeing are, in a sense, a reflection of what's going on in the rest of the world. Big rounds, those big dollars. So Austin has, you know, valuable and viable companies that are able to do those big raises and can put that capital to work. So that's awesome for the community. And so I think it keeps us, you know, in that top 10 of great places to build businesses. And investors are clearly seeing that. And it's a great place to live and work and build families. And so there's just a lot of going for the city and the area. And I think that you're seeing the outcome of that.
We're seeing a similar dynamic that everybody else is, in that the dollar amounts going up, the deal count though it's been going down a little bit. So do you see a bit of tension there? Because we don't have a lot of late stage, you know, investors here putting that kind of capital. So a lot of that money is coming from outside. So is the C to A kind of having a more competitive dynamic to get into these kind of fewer deals that have this kind of upside, or is it kind of the same that it's been before?
I'm not feeling the competitiveness increasing for the seed, just to put a statement out there to begin with. But the question is, what's the viability of these companies? And I think that like you said, when we see this incredible growth, people are jamming money into those things and growing with them. And that could pull capital away from other earlier things that don't, have as exciting a future maybe. So you have that tension going on. I'm just not seeing it yet in that seed series A getting more competitive, or not seeing that yet.
But from a deal flow perspective, are you seeing the same number of deals? Is it coming through? Is it more, less? And then is the percentage that are like, obviously you can see 10,000 deals, and if 9,999 suck, then the 10,000 is not a great number, right? So the percentage of kind of like viable deals, whether you choose to invest in them or not, but just the quality of the funnel, how are you feeling like it is? Best it's ever been, kind of the same? Where's it at?
Yeah, I would say very, very solid. I don't know if I could exactly say best it's ever been, but there's definitely very good deal flow. As we talked about earlier, it's bigger than Austin in Texas for us, so we're seeing the flourishing of other places. But we have a much bigger team now. We're seeing a lot more things, and really happy with what we're seeing. Obviously, 2025, I think we did 12 new deals, so one of the highest velocity years ever for us. And so that just suggests that at least we think there's some good things to put money to work in.
So the highest velocity, and then how did that compare like last few years? Was it like going from like 10 to 12 or like 6 to like, where's the kind of shift?
Yeah, if I remember correctly, 21 and 22 were 7 deals each. And then 23 was like 3. And then it grew back up toward the 12 here in 25.
Okay. So yeah, so we're seeing significant increase in that.
This is probably
324 low.
Yeah, it's 50 to 80% higher velocity than we've ever had.
Okay. And you see it, you see 26 kind of being about the same, higher?
I do. That's roughly that same velocity, kind of a deal a month-ish.
Okay. And from the top side, is that, are you seeing before the deal investment, is it the actual volume of kind of inbound or that you guys are hunting? Is that about the same, or is it?
Yeah, it's probably a little higher just because of the broader, geographical look. So I'd give it that. Definitely increasing.
When we talk about like those big later stage ones, you haven't felt so much of the competition. I want to kind of test the narrative I keep hearing. Try to keep my own bias on what I think of it is or not. That it seems to be that there's almost 2 distinct classes of startups, and you always think about it from the fund perspective. One is kind of like, okay, it's the classic Austin company. It's backed by the local funds that we can all name, and that's kind of one group built on these kind of numbers. And then you have the Silicon Valley style, backed by the the new funds, the ones who moved here. They almost like it's 2 separate ecosystems that they don't really play so much together. So, do you accept this premise? Is this what you're seeing, or is it that a noise that's being made and that's not actually what you're seeing on the ground?
Well, I think you got to go back and say, hey, between 2017 and 2019, there was an influx of a lot of entrepreneurs and businesses that wanted to live in Austin, but really had West Coast-ish, kind of networks. Mm-hmm. And they had and those networks weren't merged back then. And I think they've been coming together over time, but there is some level of distinction we see, always, that there's the local, and then there's the folks who have networks that are global.
But thinking about the local crowd, it wasn't just startups that moved here. It was actually funds that moved here, people that moved here that created funds from outside. Are you seeing that same distinction between them? Like that the startups that have the global network, are they being funded by, the big names that moved here as well? Or is it, everybody's kind of getting in these kind of same kind of deals? Or is it a math issue? Like, look, I don't know why I was bringing up, thinking machines. We're just not going into a $10 billion seed, but this group would.
Right. Yeah. I think there are, just capacity differences that the Austin or the Texas-based groups just don't have. And it wouldn't make sense for them to be in deals like that. Mm-hmm. And yet I do see a lot of integrating happening with the more storied, longer term Texas firms integrating and making investments with other friends all over the country at this point.
So you talk about capacity, and one of the things that I've noticed is a lot of these, and yourself included, last couple of funds, they've all increased, but they're still generally, call it, 180 to 280 kind of range. And so obviously that drives some of the capacity. Why not? Why both your and for you guys, but why are we seeing some of these funds where I'm like you said, like 8, 5, 6, 7, 8 going for a half billion? Is it all or more? Is it about strategy? Is it about growth? How are you thinking about it?
Well, I think in kind of classic portfolio theory, smaller is always has the opportunity to have, bigger multiple outcomes. And so we've tried to keep the discipline of staying in that 250 range and call it 20 to 25 deals in that, kind of fund. And that seems to have had good return principles over time. And so we're kind of sticking with it. I don't know that it would make sense for us to bifurcate and have a 250 and a 2 billion. Those things are so different in what we know how to do.
I have you here, and I want to use this opportunity as someone whose opinion I trust a lot to actually sandbox a few of my theories about Austin.
Okay.
And you're full well to say that you're nuts. I don't agree with any of this, so I won't take it personally. Like that's that idea. So so one of them is I've been calling Austin recently the autonomy capital. And I think about that, and that frame has been growing in two different ways. Right? So one is thinking about like machine autonomy. So we have a lot more self-driving cars, robot companies, drones kind of above and below ground. But also more recently, I'm thinking that term like human autonomy. So a lot of this education experimentation, you've got things like web AI doing decentralized AI, on device. A lot of push about agency, both in kind of the writing and thought community. So when you think about Austin as the city, about the portfolio, the market, am I hyping too much? Or is there something kind of there?
Well, clearly you have some data to support the thesis. And I think those
Being a
things
writer,
are,
I also do BS really well too. So
yeah. It's exciting to see those things happening, Jason. I think there's truth there, that what you're observing. And yet my question would be, kind of to what end are we looking for it to, put a name on it or to really, see innovation happen? So anyway, I think it's an interesting observation. There are these interesting cycles happening. I don't know if I mentioned this, but we had not invested in any fabless semiconductor deals in 20 years. And then this Mythic company shows up and they're doing some really amazing stuff in inference. And so, would I categorize that as autonomy? Well, it's going to be edge. And so it has so it's here. So yeah, it supports the thesis and we're excited about that. But again, I'm not sure that it's the only good moniker for it.
to your point on the innovation and what's the end goal, right? Put a name on it. So I think that narratives at a kind of city and ecosystem level are underrated in their power, right? So you think about why is everything Silicon XYZ, which I do with a passion. Because there's a transference, the perception of this means tech, and we're going to be like this label. Now, I think the derivative naming conventions have negative power because by their nature, you're saying we're going to be second best, right? We're going to be a pale comparison to this. It wasn't like Silicon Valley went and said we're some shade of like Motor City or the Big Apple, right? I didn't make some out of that and stuff like that. So one of the reasons I'm a big fan of a lot of what guys are doing in the Gundo is they didn't call it Silicon Gundo. Like they already understood at least the narrative power of that. Same thing with, when you go back, like we still use the term Renaissance today. And that's, it transcended what was, the city of Florence 500 years ago.
Right.
It was one of the big observations that I had when moving here, because at the time, this isn't true anymore, San Diego's numbers in terms of innovation and so forth were better than Austin's. But if you, like significantly better, let's use VC funding, Austin was like 8, 9, someone using that range. San Diego was a very clear 5. Today, San Diego's taken a bit of a step back and Austin is solidly 5. Last time I looked at the numbers, we're about $1 billion ahead of Seattle and like $2 billion behind, I think Boston or LA sports. So we're not moving from that spot, but like it's kind of solidly ours. So, but when I ask people like that coming in, everybody assumes the opposite. Everybody already assumed that Austin was in that position.
Hmm.
And so we talk about like 2017 to 2019, people kind of, moved here. They wanted to be in Austin because of that narrative, right? And I think now the narrative is even expanding to be, oh, well, if I want to be in defense tech, if I want to be in, something in, I'll call it countercultural AI. Like, if you're going to build a foundational AI model, go to San Francisco. But if you're trying to build something that looks different and maybe competitive, you want out of that bubble, like you have that. So I think that's what the narrative and the naming conventions and some of this and coining holds greater power than I think has been given credit.
Yeah. Well, and I love the fact that you're kind of identifying these things as a relative newcomer, if you will, relative to my 35 years. And I've just been in the pot boiling for too long to see the distinctions. But those are great. Those are great identifying things. And I love the fact that it is that clear in your mind and others. And so, yeah, we welcome that for sure.
Holding on to my newbie status as long as I can. I feel like the 5-year mark, I don't get to do it anymore. Like it's, when I become like, well, back when I got here, it was perfect and nothing is changed. We just got to get back to that. I think it's trying to be a little more core. Like, no, actually it's tomorrow and tomorrow and tomorrow is going to be better.
Yeah. Well, and you mentioned the defense tech thing. That's clearly a thing that has happened in the last kind of this 5-year window that you're alluding to, but exciting to see it. I think that's a great place for Austin to thrive. So yeah, excited to have it here.
Yeah. And I think one of the things, while taking like defense tech being, relatively the last 5 years and only I think as a venture space, call it the last 10 to 12, kind of thing. But what I think so many people move to Austin for Austin, and now suddenly there's the narratives of these deep sectors. And so it's not like Austin appeared 5 years ago. It's, as you said, like it's a 30, 40-year overnight success from, MCC to IBM to Trilogy and Dell to on and on and on. And so I think that's the nature of some of these things versus, when I hear the thing, well, we want to create, this is our we're the new Silicon Valley here in this XYZ city. It's like, okay, what's unique, what's special, your point about the semiconductor, the history of, I think we build physical things in Austin and in Texas in general that isn't done in other places. And there's a history to that. It's not just like, well, we built, right?
Yeah. Well, and there's a joy to the tangibleness of building, a physical thing. And that's certainly been part of my joy in my medtech investing. Is there, physical, tangible things? Software is great, solves awesome problems, but you can't really hold it. And so these tangible things are kind of enjoyable to see put together.
Well, and they create the next level of inspiration, right? So, I took, my 2 older kids and my dad down to see the SpaceX Starship 6 launch, right? And it's something that kind of sits with them. Or when you go downtown, when you see the physical, there's a sense you can get differently. My 6-year-old saw Waymo and said, why does it have a steering wheel? And I'm like,
awesome.
That's a really good question.
Yeah.
Seeing software is not going to ask those same kind of intuitive things that when you see a robot, you see a drone, you see just something in the physical world, there's a different level of relationship with it that you can ask, that a 6-year-old can ask insightful questions that it takes for some of these non-tangible. You need to be well on your way to really get to insightfulness.
Yeah, and you're exactly right. When we can, in the physical world, we can ask why. And the 6-year-old did a great job of saying, hey, there's no driver. Why is there a steering wheel?
Then you have to explain it because it's just a Jaguar, and like they kind of adjust it. Yeah, so there maybe shouldn't be.
The beautiful thing about the Waymo in your example, you see all that physical stuff on it. That stuff is all going to get miniaturized and go away visually. And so it's just a beautiful reminder that it can be done, and now we're just going to make it better.
There's an interesting distinction. Like, I'm glad that the Tesla cyber cabs are going to be gold, because on one hand, like we count Waymos, you can see them, you can get it as the things, and I'm not getting into the LiDAR versus camera fight, like much smarter people than I can have that fight. But you almost, in one sense, I almost don't want it miniaturized because you want to be able to notice and see it. Like there's this, the whole invisible, right? Our phones just work, like technology becomes invisible, but there is something about feeling like you live in the future because you see something that looks different. You can see tangible change.
Sure. Yeah.
So,
No argument there.
all right. So I always ask with the same question, what's next, Austin? I'm evolving, I'm changing, I'm trying not to, do some new things. So you were actually the first person to kind of get with the kind of the new ending question. So hopefully this will be fun. So it's more now about like what's next that's on your radar. Like, is it a trend, a technology, an experiment, something that's coming up that represents a hinge point in innovation?
I'll start with kind of the venture community, and I'm hopeful that the local firms and even the ones who have come from outside that are national in their focus can be multi-generational. In other words, I want to see this thriving and flourishing go on into the future. And so I think one of the things that I'm just tracking is will it get handed down and continue to go. That's one exciting thing. In terms of specific technology trends, I don't know that I have a lot to say. I'm excited about the healthcare work that's growing in Austin. And so I think there's a lot of viability to growing certain med tech and healthcare IT and other things like that can happen here. And then just the kind of the classic software AI solution set that I think can be here. So I don't know that I have specifics in that area, but I see the thriving over the past 3+ decades as moving into these new spaces. I'm sure there'll be more coming.
Great. Brian, thanks for coming back on the show.
Great to see you, Jason. Thank you for the time.